We're here with Zach Armstrong, Chief Investment Officer at CN Investments, to talk about portfolio rebalancing and why rebalancing is important not only during the good times, but also when the market drops. Keeping in mind that your investment policy statement here at Sienna was devised with a long-term approach, taking only the risk that's needed to have success during your retirement.
Thanks, Joe. To show the importance of rebalancing and looking at your portfolio during these times is best to go through just an example, in my opinion. So you'll see here we start off with a $100,000 portfolio with two asset classes, and ideally you'd have many more asset classes to benefit from diversification. But for simplicity purposes, we're going to stick with 50% in the stock market and 50% in the bonds. And this is 50-50 allocation that's determined through your investment policy statement. And that's really unique to each individual based on their need, ability, and willingness to take risk, and what will make their financial plan successful over the long term. So you can see here, starting the year with $100,000, we've got $50,000 in stocks and $50,000 in bonds. Just to make it simple, we're saying this mutual fund is $100 per share, and this one is also $100 per share. So the investor owns 500 shares of both the stock mutual fund and the bond mutual fund. Fast forwarding to the end of the year, we know that stocks have lost 30% in value, and bonds are actually up 5% in our example. So what does this mean for the investor, and what should they do with their portfolio, if anything, during these times? So we can now calculate the effect on the investor's portfolio. So looking at the $50,000, we know that they have lost 30% in value. So their $50,000 in the stock mutual fund is now worth $35,000. Same thing for the bond fund. We know that the bonds have gained 5%, or are now worth $52,500. So for the investor, they have an unrealized loss in their stock mutual fund of $15,000 and an unrealized gain of $2,500. We say unrealized because the investor hasn't reacted to the market going down 30%, and they haven't sold out of everything and gone to cash and actually turned that unrealized loss into a realized loss. So you'll see off to the side, we still own 500 shares of each fund. But what does this mean for the price per share? We know that it has gone down 30%. So this mutual fund price per share is now $70. And conversely, the bond fund is now up 5%, or worth $105 per share. So looking at the 50% mix, we know that our portfolio is now worth $87,500. So looking at the total portfolio effect on what has occurred, we have lost 12.5%. And that's the importance of diversification, and specifically for this investor being 50% in bonds. They're not down 15%, being half in stocks, going down 30%, but that loss was mitigated from the bonds. And the portfolio effect, we want a zigzag effect. When one asset class is down, hopefully another one's up, vice versa. So now we know the new price per share and the new value of our portfolio. What does that mean for the investor? So we've got $35,000 in stocks and $52,500 in bonds for $87,500 in our total portfolio. We know we were targeting a 50-50 allocation, but just doing the math, we know we're now in 40% in the stock mutual fund and 60% in bonds. So our allocation is off drift, I'll call it. What does this mean? This means that looking at the historical portfolio statistics of each portfolio, that the investor is now in a less risky portfolio, being less exposed to the stock market, and therefore they're taking less risk than they need to take according to their plan. They've now cut their expected return by 0.5%. What this means, the downside is limited, but we know that they need to take more risk in order for their financial plan to be successful. So what do we do? We look to rebalance at these times. So just applying the statistics of the portfolio, you see we've got a 40-60 current split. We want to be 50-50. That means we need to target $43,750 in the stock mutual fund and the same in the bond fund. So that means we need to sell $8,750 worth of the bond mutual fund and buy back the stocks. Knowing the new price per share, we can calculate how many shares we're going to buy. So we're going to buy 125 shares of stock mutual fund, and we are going to sell 83 shares of the bond mutual fund. So what does this mean? So we had 500 shares in our original example. Now we own 625 shares of the stock mutual fund, and we have lowered our shares of the bond mutual fund to make it balance. So let's look at a hypothetical example, because now we know we've bought more shares at lower prices with the stock mutual fund. What happens if we don't do anything? And let's say next year stocks rise 43% and bonds actually go down 5%. So applying this math, we know the new price per share will now be $100 per share, and the bond mutual fund will now be worth $100 per share. So if we had done nothing, we now own $50,000 in the stock mutual fund and $50,000 in the bond mutual fund. We are back to break even. However, we know we have rebalanced. So the new price per share is $100 that we've calculated, but we were able to take advantage of the low prices, rebalance our portfolio back to our target allocation, buy more shares at cheaper prices. So what does this mean for the investor that is rebalanced? So we have now increased our portfolio value about $4,166 per share by taking advantage of the market dip, reallocating, making sure our risk is at the appropriate level. And now we're in a situation where we look to rebalance the other way.
Thank you, Zach, for that illustration on rebalancing your portfolio. As you can see, it's an important part of your overall success in your wealth planning. Reach out to myself, Joe Irish, or Zach Armstrong, or any member of the Sienna team to see how we can help you prepare for retirement. Thanks for tuning in today. We hope you enjoyed this video cast. Have a great day.